Hi everyone, Tim Melvin of Banking on Profits and the Community Bank Stock Investor, coming to you from down here in a very warm central Florida today. Nice and warm and muggy. We're really right into the swing of summer, and don't you know, I just love it this time of year down here in Florida. Anyway, the markets are down today. We've been down something like 9 out of the last 10 sessions, and it's primarily on trade war concerns. China and the U.S. are really barking at each other in the international markets, and so far it seems like we're winning, but not without some casualties. We kind of knew that would happen. There's talk of additional trade problems or wars or fights or arguments. Not just with China, but with Europe and China and Mexico. And it's just a real mess. I think it was probably inevitable that we had some big rewrite of our trading policies with many of our partners at some point in time. But nobody ever said it was going to be fun. So the markets are moving down, and the big question of the day is, markets are going down, and is it time to buy? Should we be jumping in? Are we buying the dip? Is the market cheap? No, the market's not cheap, guys. Let's use numbers here, okay? Yeah, we've been down pretty much for 2 weeks now, but we're still not that far down off of all-time highs. If you look at the market in general, I took the S&P 500, okay, and we ran the median F score. It's a 6. That's pretty good, okay? Business here in the United States, especially post-tax reform, some regulatory relief. Business is pretty good. If we get an F score of 6, that's in the top 3 scores. Tells us that fundamentally and financially solid, and things are pretty much going okay. On the risk side of it, if you run the credit scores, you get a Z-score on the S&P 500 of about a 2.86. That's real good. Okay, corporate America's balance sheets are in fantastic shape. Everybody's paying their bills. There's no sort of financial weakness or anything that we really need to worry about in America's largest companies. So, business is okay. Financial conditions are excellent, but we're paying too much for that because right now you're at median enterprise value to earnings before interest and taxes is 17. Now, keep in mind that the average takeover multiple for a private equity deal right now is considered to be egregiously, if not dangerously high, at about 11. Leon Black of Apollo says most of his firm's success comes from the fact that they like to buy things with a 6 handle on that EV to EBIT number. So, the market is really priced for perfection and beyond. We've got 3.3 times book value. The price to earnings ratio of 25 according to this weekend's Barron's, and a 1.94% dividend yield. That's nothing to get excited about. I'm certainly not selling the kids or pawning one of the cars or anything to raise extra cash to go out and put it into stocks right now. It's not 1999 high, but we're very close to, say, 2007 type highs. So, no, I'm not running out to buy the market, and we have not had enough of a pullback in our small banks. In fact, most of our small banks have been very strong in the last 2 weeks. So there's been nothing there to get us excited to run out and buy a whole bunch of new stocks. So, should you buy the dip? Only if you're a really good short-term trader. Hint, you're not. Most people, there's much chance of us all being short-term traders like Paul Tudor Jones or Jim Simons or some of those other guys. Okay, odds are akin to starting tomorrow night in center field for the New York Yankees. We couldn't even start for the Baltimore Orioles. Okay, short-term trading is very hard. It requires super sophisticated, high-end math skills, massive computing power, and there's just not that many guys that are good at it, and that's okay, because using an approach that actually is I don't want to say hard, it's psychologically difficult to maintain, but actually pretty easy to implement. That was why Walter Schloss, in an interview years ago, said he thought that people should pick an investment style that best fits their personality and their belief system, and he thought most people should go with the value investing system because it was the easiest to implement. Psychologically, that's not always true because you are always buying when everybody else is selling and puking, and selling when everybody else is popping champagne corks and loving the market. So it can be psychologically difficult, but it does lead to higher returns over an investing lifetime. But anyway, so no, the market's not cheap. You should not be getting excited about stocks here. Um, Business is okay, but if you look at the larger companies in the country, it's going to be very hard for them to grow at much faster than the underlying rate of the economy. And right now, all the economists are still saying, looking out, 2% is an upside target. So let's not get too excited. It's not time to buy. I wish it was. Cash balances are building in the portfolios. It'd be wonderful to go out and buy a whole bunch of super cheap banks and it would be fun, but it's not time yet. So anyway, we're going to go back on the Bitcoin attack along with my legendary better but not great economic call of the last 6 years, for which I get absolutely no credit. I've also been very bearish on Bitcoin the last 6 to 9 months, and I'm hoping to get an analyst award for that any day now. And I'm going to continue with it today. The Bank of International Settlements in Switzerland came out, and they had a report that said, hey, Bitcoin could be worthless, zero. They pointed out that the market in Bitcoin is very inefficient. It cannot be scaled beyond a certain size. So how are you going to put these multi-trillion-dollar economies and transact in Bitcoin? Answer, you're not. They said the value is not stable, and that's a huge factor. Okay, and let's face it, if you bought Bitcoin at $18,000 to $20,000 earlier this year, and a lot of people did because there was so much excitement and hype, and everybody was screaming about Bitcoin, 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 and a lot of people bought it, and now it's worth $6,000. Well, you can't buy as many candy bars now, can you? People don't like the value of the currency to fluctuate that much, especially in the short term. We don't like it in the long term, but we can tolerate it. In the short term, it cannot be tolerated. So it's not really a great medium of exchange or store of value. They also pointed out that Bitcoin prices can be manipulated, and we saw that earlier this year. Excuse me very much. With apparently the Tether pricing influencing Bitcoin. My son-in-law could explain this to you much better than I can, but that was all a rigged market, and that pushed Bitcoin much higher than it ever should have been. Didier Sornet and his team at ETH Zurich, that's a science and engineering university in Switzerland, they said that it's not worth very much because it's not really, it's not market-based. It's not backed by what they call a we owe you, the full faith and credit of the United States, the full faith and credit of the European Central Bank, as in the case of Europe. There's no we owe you there. There's ultimately no backstop, not even a handshake backstopping Bitcoin. So it's just the faith that you have in each other in the system. And I can tell you, in large groups of people, the faith in each other is going to break down relatively quickly. And they also think that Bitcoin uses outdated monetary theories to attempt to control prices. Now, guys, more and more smart people are starting to come in, and they're really doing an economic study of Bitcoin. And as exciting and interesting as the technology might be, it really doesn't work as a currency. So you're making bets on the future of blockchain, but you're using this coin, which is worthless potentially, to make your bets. Not a game we should be playing. I don't understand it as well as I'd like to, in spite of reading about it extensively. So those who have not read about it at all should not be attempting to trade this stuff, no matter which guiding light they may have chosen to illuminate the path. There's plenty of other ways to make and lose money, so why go into one that is almost guaranteed to lose you money in the long term in the form of Bitcoin, where you can easily be defrauded because it is very complicated and hard to understand, and it's easy to get down the wrong path. So again, this week, stay away from Bitcoin. You don't need it. There's plenty of other ways to make money out there in the markets. Okay, the bank stress test. The first part was done last week. We'll see the second half, the capital plan, later this week. But listen to the scenario that they had these banks test their portfolios and businesses for. They had to assume conditions were a severe global depression. GDP growth rates were 7.5% below the most recent peak growth rate. The unemployment rate was 10%. Treasury rates were near zero, but long-term rates remained elevated. So you had this massive yield spread to deal with. You had VIX rise above 60 and commercial real estate prices down 30 to 40%. That's disaster world. Right? That's 2008 at its absolute very worst. And what happened? Well, because so much capital's been injected into the banking system since the debacle of 2008, all of the banks survived. A couple of them had to go back and amend their plan. Goldman Sachs is kind of arguing about some of the definitions that were used. But upside is everybody passed and survived. In fact, even under that scenario with the devastating stock losses and bond losses and severe declines in collateral values, capital values averaged at the largest banks 7.9%. That's falling from 12.3% today, but that's above the average bank capital rate when all this started back in 2007. So banks survived. The fact that they survived under this economic disaster means we're going to see a lot of return of capital payments allowed when we look at the capital plans later this week. You're going to see higher dividends. You're going to see massive stock buybacks from some of these banks. So the big banks should get a pop, and that's probably going to pull our little banks up maybe just a little bit right along with them. The other big banking news is, oh my goodness, deposit wars are really heating up out there. You're starting to see the ads. Populaire, a large regional bank, is now offering a 2% instant access online account. So a lot of banks are going to be, to slow down competition, deposits leaving their bank, they're going to have to get up to that mark. What it's really going to trigger in our banks, community banks, is M&A. Because quite frankly, it's just going to be a lot easier for a bank to do what Triumph Bancorp out of Dallas did a few months ago, and that's go find some small urban banks with excess deposits and just buy the banks, buy the deposits. We're going to see more and more of that. We've got a lot of those banks in our portfolio that have, excess capital, plenty of deposits. So buying deposits is going to become a very big thing, and it's going to drive M&A in the second half of 2018. And if all goes according to plan, we will benefit mightily from the deposit war in the rest of this year and going into next year. If rates continue to rise, this merely accelerates along the way. So, okay, that's really about all I've got this week. The trade war, if you want to know about trade wars, you can turn on any TV channel. When they're done talking about the mess at the border, then they'll come back around to trade wars. You can read any newspaper. What I like to do, I do this every weekend. I read the New York Times, I read the Wall Street Journal, and I look for the point that's in the middle because that's probably the closest to the truth. That's a great way to read the news on the weekends, I've found. So, anyway, on to baseball. My Orioles won a couple games this year. We're still the worst team in baseball, right there with Kansas City Royals. We kind of trade back and forth for who's worst from day to day. Really, I'll watch the season out. I'm a very loyal fan. I've been with the Orioles through, well, not quite as bad as this, but almost as bad as this at this point in the year. But the real highlight to the rest of the year is what I want to see now. My hopes for Orioles in the World Series are dashed. Now I just want Manny Machado to be traded to the Chicago Cubs. Why? Well, I've always been a bit of a Cubs fan. But, years ago I used to say that you don't have a heart if you don't root for the Cubs at least a little bit. And then of course my son-in-law moved to Chicago and lives reasonably close to Wrigley. We can walk down to the stadiums from his apartment. We went to some playoff games. My daughter and I went to a World Series game while I was up there. And that's just a lot of fun. We've created some family memories around the Cubs. So we root now for the Orioles and the Cubs. And because my wife's from Texas, we don't mind the Astros a bit either. So we want to see Machado go to the Cubs run away with the National League, and then meet the Houston Astros in the World Series. A, that's what I'd like to see, with my sympathies in my heart. B, that's also the way I bet it in the baseball futures market earlier this year. So that would make this season acceptable. This week, and I thought it was last week, it was in my head for some reason, but this week we have the series with the Seattle Mariners, which is a key series because I've got a very good friend out in Seattle. Every year we make a bet based on how the two teams do during the year, and if the Orioles can eke out a series win here against the Mariners, it will be at least a moral victory, which is better than no victory at all, which is what I'm going to get from the rest of the season for the Baltimore Orioles. We are not going to the playoffs this year. So, baseball surprises this week, just to remind you how crazy this game can be. The Yankees, best team in baseball, lost a series to the Devil Rays, the Tampa Bay Rays. The Cubs, National League powerhouse, got spanked. And they didn't just get beat, they got spanked. by the Cincinnati Reds over this weekend, dropping the series to the last place team in their division. So it's a crazy game. It's why we watch, and there's still a lot of baseball left to come. Please trade Manny to the Chicago Cubs. Thank you. All right, books. Guys, I've gotten so summer lazy. Just my nonfiction reading has gotten off the rails almost entirely. We got to get back into that. We'll start doing that this week. But some of the notable stuff, the Caps Place series by Jack Tarrant, excellent series, kind of action adventure set down here in Florida, over in Hollywood. Great book. Then we had Paul Levine. I mentioned this last week. Bum Deal, the new Jake Lasseter book. Oh boy, fantastic stuff. I recommend you start at the very start of this series. I think this is the 14th book in the series, but they're great reads. This one, well above par. And then we had the Dresden Files book. Absolutely love that. That's grown up Harry Potter with an attitude problem wizard. There's a collection of short stories. Really enjoyed that because I really like that series. Just fun, kind of an adult version of Harry Potter. If you liked Harry Potter and you're grown up, you would like the Harry Dresden series, so I can highly recommend it to you. Looking out, we've got Dawn Lee McKenna's the new issue in the Forgotten Coast series. That will be out tomorrow, automatically delivered to my Kindle at midnight, they tell me. On the nonfiction front, my next book, I've got to finish The Merchants of Debt KKR. I'm almost done with that, but as I said, I've been incredibly lazy on the nonfiction front. Ken Ligone's I Love Capitalism. I Love Capitalism too, and they tell me that this is a really good book and a great read, so that'll be next. Coming down the road, we have a new Ace Atkins novel. We've got a new novel in the late Robert Parker's Jesse Stone series. And Brad Thor has a new Scott Horvath book coming out in a reasonably short period of time. So still lots of great summer reading to go. We're going to get back on our nonfiction trail and read a certain percentage of nonfiction every day. And that's really about all I've got this week. Yeah, markets are down, but they're not cheap, so it's not time to buy. We did add the 3 super small bonus banks to the Banking on Profit portfolio last week, but we don't have a lot else that we're seeing that we want to jump on. Nothing that is liquid enough to get in, and my definition of liquid is pretty generous, okay? So nothing even reasonably liquid that we can get into the main portfolio right now. We're hopeful that continue. We see some changes in the market and we can get more money to work, but we're completely comfortable. We have a tail hedge in place. We have lots of cash in the portfolio. So we remain in a win-win buy scenario. So we're in good position pretty much no matter whatever happens over the second half of the year. So anyway, lots of baseball, lots of books. We'll see what the market does. You guys have a great week, and hopefully I'll talk to you next week.